Welcome everyone to the Kindle Report. Hey, I missed you guys too. It's kind of weird actually showing up every day at work, but I'm not going live like I used to. Still working on some new content, so thanks a lot. We got a few people. Obviously, this was unexpected. I just felt like this was a real big week, and coming into year end, as most of you folks know, I shut down the channel every year at year end anyway. And appreciate all the nice comments, and we'll see. They're still working on a lot of family issues, and I appreciate everyone. So a couple of announcements since I haven't been on. The seminar that we did several weeks ago is still being edited, but almost done. I just have not had the time to dedicate it, but it's very, very close. And there's a master class, so make sure there's going to be an offering coming out sometime in the next several days. Watch for your emails, and I'll put some things on Twitter or X as it goes. And about another Christmas special that we're going to put out. Just trying to keep everything rolling along here pretty good. So a lot going on, folks. I'll probably be a little rusty, but let's get into tonight's video. Thanks again for showing up, and we'll see how many folks show up as we go through the night. I don't expect that many views after being offline. Hopefully a lot of you have hit that notification bell. There is some content that I'm working on that I think you're going to like, but let's talk about this week is big, right? This is the final meeting of the Fed that's coming in. We've got a bunch of economic stuff coming out. We're looking at right now, just to go through that stuff, get it out of the way. CPI is coming out on Tuesday, expected to be 0.1, the core 0.2. Wednesday is PPI, that's 0. And then the core is at 0.1. So it looks to, the markets are starting to think, hey, the Fed's done. I believe they are done, but I don't think they're going to lower rates as much as people think. But we'll talk about this because my interest rate outlook and some other elements that I'm going to talk about tonight may surprise some of you. And so we're also looking at with the FOMC meeting on Wednesday, no action is expected. I think if anything, what I made a note here for you folks to pay attention to is any comment about anything with the QT. And I think I've been telling you, if you go back months ago, this is what is the key element from the standpoint of the things that you're going to watch the most is QT. Any mention of downsizing, anything like that is going to be super bullish, I believe, for as far as interest rates go. Will it be bullish for the market? Probably so, but maybe not in the way you think. So I'll try to unpack a bunch of stuff here tonight. I don't know how long we'll go, but I'll go through pretty much a normal sequence. Like I said, I just felt like I really needed to come live. I was looking at these markets, and we've watched Bitcoin go to 44,000, all kinds of stuff. So I'm going to do a full spectrum of what I normally cover in my normal live streams. But we've got, so FOMC on Wednesday, no expectation. Watch for any kind of mention. Most likely they're going to have somewhat of a dovish tone. Looks like then on Thursday we've got claims coming out at 218 and continuing claims at 1861. Want to bring up a quick comment here. Folks are still talking about this recession that's coming. And I feel like the Grinch or something. There's no Christmas coming. Well, there's no recession coming. And it's just not going to happen. We would need to see, I'll give you an example. Recessionary numbers on claims would be in the 350 to 500,000 range on a weekly basis. The continuing claims would be probably in 2 million to 2.5 million. To even get those kind of numbers would reflect a recession of a sort. And we're just not seeing those numbers come out. And I don't think we're going to see it. Well, we had GDP come in at 5.2. Yeah, and I know everybody's going to say the numbers that you see, the economy's not that good. I don't see it that bad either, folks. I can't find it. You go out into the world, I don't see anything really slowing down. We have seen a hit on real estate, some things of that sort, but for the most part, things just keep moving forward, and that's pretty amazing. Friday, just a quick mention. I've got this up here. Actually have a new setup here. I'm looking at Friday. We've got the claims coming out. Capacity utilization is coming out. Let me just move something around here just so I can get to some other numbers. Let's get to Friday's numbers here. So Friday's numbers are looking at, we've got services, PMI, S&P Global. No one cares about that. Also, we have S&P Global manufacturing. No one cares about that. It's expected at in contraction mode, but we're looking at 49.4. And then there's really the only other thing that is coming out here is bear with me 1 second. I didn't write down. So we have Empire State Manufacturing coming out. That is also looking at some this is another low impact at 3.0, and then we're looking at the industrial production from that standpoint, looking at that at 0.3 positive, and then capacity utilization at 79.9. So none of these numbers these are not the kind of numbers you get in a recession or those type of things happening. Now we've seen, and I'm going to go through some detail here in a minute on the long-term treasuries, especially in the back end of the curve. This has been moving pretty strong. And if you remember going back even to the video I did last week and then going back to my normal videos, I was telling you that as we come into December, there's quite a bit of expectation of lower rates, especially on the back end of the curve. So all of a sudden there appears to be easing going on. And I've talked to you about this before, is that this easing is actually happening due to really the market's expectations, and they're going to set up a tone where maybe we can get a bounce in real estate, we can get some of this stuff to stabilize and move from there. So I'll save some of that dialogue as we get into the interest rates here in just a minute. So let's go ahead and let's run through a typical show here. And I am going to cover a couple other elements that I think are important. And this really probably is likely to be the final video like this for the year. Maybe there'll be one next week. I'm not planning that far ahead at the moment, I will tell you that. But this will probably be setting up a lot of what's likely to happen as we come into year end. Let's go ahead and take a look at the WaveTech database and see if we can get all that. I actually, just a warning, just in case we have any glitches, hopefully it'll be fine. This is why it took me a little longer to come live, is I put a new video card in this computer and the res changed on a lot of things. So I think I got it all zeroed in. Let's go ahead and get into that. Hang with me. All right, so let's start here. The weekly database, pretty amazing, folks, and a lot of what I would like to talk about here is this is phenomenal. I'm going to bring up a couple things that I think is important to understand. But this is it. We're at 73.1 symbol long right now. And this is important. I've had people tell me for years, especially some trolls around Twitter and some folks that told me in January when I told you the story I'm about to share with you right now, is I told you that the forward-looking nature of this database is huge. Well, if you recall, going back not that many weeks ago, we were getting right to that 42% level. And here we are at 73.1. And I'll go through a couple pages. I'm going to try to navigate through this because I do have to manually switch. I normally have a switchboard to change scenes here, and some of this stuff got messed up just by not using it and changing the res on the computer. So let's just talk a bit about this, is that the likelihood now is that the entire system is now carrying us forward into Q1 of next year, possibly all the way to the end of Q1, that we're going to have a positive rotation. I'll cover this in a minute, but there's a better than even chance that we're going to see an all-time new high, possibly by year end, maybe from basis the S&P, and certainly we'll see this as we come into Q1. But there is a whole new rotation that's happened here. Let me go over to this other page and let's bring up some of these other stats. They might be a little small because of the res change, but let's just take a quick look. So I'll cover them one by one with you. But this table over here, the positions overview, where we are right now, the typical optimized holding, meaning our best models on these stocks. Now there's 15,404, 11,246 symbols are in trend mode. And I just need to reiterate this because a lot of folks, maybe you forgot since I haven't been live, but these are not just stocks over a simple 200-day moving average or a 100-day moving average or any of those. The fact that something's over a 200-day moving average doesn't mean it's going up. It could be crashing down towards its 200-day moving average. And somehow there's folks that think that's still positive because it's above that number. These are different. Every one of these signals have a probability, and they're also telling us that 11,246 stocks are in trend mode, okay? Meaning the probabilities are stacked towards all of those symbols appreciating. Now, I'm not saying they all will, but I'm telling you 60, 70% of them will appreciate, some more than expected and some less. But on average, probably 60% of the expectation is going to be yielded. So let's talk about these numbers. It's been a while, and I may not be talking to you for a few weeks. So let's just go ahead and go through this real quick. So right now, the optimized weekly, I'll highlight this. It might be a little small, but I'll read some numbers to you. The average duration is 204 days. Right now, the current duration is only 54 days, telling us that there are, 150 days. These are trading days. So that's the better part of 4 to 5 months looking ahead. Also, if we look here, the average profit on these trades, I'll just highlight these numbers and tell you what they are, is 30.17. So on average, those stocks that are in there are making basically 30% over that 204 period. If we look at the current average profit, 4.5%. So looking forward, even if we just get a half of this returns or maybe 3/4 of the returns up and around that 70 percentile range, you're looking at the average return on these symbols are going to be probably around 20%. And right now we're only at 5%. And they very much could continue on and hit their mean, which would be that 30%. So I wanted to make sure you folks understand that this is a forward-looking indicator. If you go back to January of this year, and look at what I was telling you folks, I told you we're going to see at least into second quarter, we had a rally. Well, we got this refresh period. And as we came into the October lows, just like last year, here we are recycling everything going forward again. Now we're right back into that mode where it looks like we're going to come into this seasonal period, which has already been strong over the last several weeks, to continue into year end and probably roll over into January, maybe get the January effect, and weeks one, maybe weeks up to 2 weeks into 2024. I always joke every time a year rolls over, I'm still waiting for Y2K and the blow up. But the bottom line is what we're looking at here is this forward-looking environment. I haven't covered, but I'll go over here real quick just so you can see these numbers. And I'll put it on the screen here. But the short term is at 80.25, so 12,361 symbols. And right now, because of the rally in the bonds, just about everything's long. And it's, yeah, these are crazy numbers, folks. And this is in spite of everybody telling you there's going to be a recession. So this is a very interesting period. So let's get into the technical. 1 second, before I do that, let me just do one thing here. I'm just trying to see if I can find something. Yeah, it's not available, so we'll just move on. And thanks, Brad, for the Christmas present. I appreciate that. All right, we'll start off with the hourly chart like we usually do, but it's all jacked up because of the rollover that happened last Thursday. It's interesting because I have my TradeStation stuff to roll over a little later, not until the end of this coming week. But regardless of what's going on, we're seeing some normalization already of these markets. So 46.59 is the price. So if you're using a nearest futures chart, let me just flash over real quick here to this is, I'm just going to bring this up, so I'm going to bounce you around a little bit. This is my nearest future, doesn't have that gap in it. We're seeing this thing start to move up just here on TradeStation, and we're looking at right now, it shows 57 higher on this, and this is probably not a good indication of what's going on. So let's go back to the hourly chart. It looks to me like we're probably going to do our classic where we decline into the London Open. So let's get into the dailies and just move forward here. So we look at dailies. I saw some really funny comments on Twitter. Somebody was commenting they've been around the markets for 20 years and never seen a 45 handle gap on the S&P chart, not realizing that it was just a contract rollover. That's kind of funny. But look at the angle of attack here, and I was talking about that just a number of weeks ago, that it looks like we're going to go right into year end. That angle attack should be in play, and we're seeing the algos flatten out a little bit, and they did come down. I kept thinking that maybe we'd see some downside in this market, but we just continue to get this bid. Now, we did manage to get an RTX sell signal on Friday, so we could get a few days sideways, maybe into the Fed meeting. But overall, the angle of attack is going to stay in play. And where this is going to be most visible here is on the weekly. Now you can see weekly momentum is trying to flatten out, but if I use my cursor and come over here on the AR on the auto regression, I have to come over to, let's just get a number here. Yeah, even coming into all the way into early January, we're still in a positive. The PPMs are still upsloping. That's why you see this angle of attack still rolling up. But it does look like we got a shot at maybe flattening out as we come into year end, but it looks like a steady bid. And the numbers that you're going to want to watch is the 21-day simple moving average as a support line. And then on the weekly, there's very little probability that we would get above below the 10-period moving average. So that will be pretty much the play as we come into year end. And I think the market grid on the weekly, so those of you that have the indicators, just watch the market grid on the weekly chart. That should set us up pretty good from that standpoint. If we come over here, I'm just going to go over to the monthly chart. We still have that upward slope. The market grid is up. My expectation as we come into January is that the market grid will flatten out, and then ultimately we'll see some consolidation maybe as we start the beginning of the year. That looks like what's in play. And what I'm going to show you next from the standpoint of where I think there's a big rotation that's going to happen in the market, and this will be the only thing, not the only thing, but one of the things that I think is going to be really important to follow. And yes, I see a comment here. I am going to cover gold and Bitcoin. I'm doing the whole spectrum tonight. But the bottom line is we're going to see probably some consolidation at these higher levels. We can see if we go over here on the futures, the actual high was 47.99 is the high on this nearest futures chart. So that's not even a big deal. We're 46.50. We're $1.40 from printing up to that number. But the angle of attack, everything is still very bullish, even though the PPMs are starting to roll over. What you're seeing is a rotation going on where the PPM 2 is actually going to kick in, telling you that the markets are going to just remain in this uptrend. And it's interesting going back, if we go all the way back, I'm putting my cursor back at October of last year. But as we came into January, I thought we would stay in this uptrend, and that the database is so powerful in determining this look forward period. And like I said, we went from around 73%, we dropped down to 42, which is the magic number, and now we're back at 71 on the intermediate. So there's been a big rotation, and this can kind of go on multiple times as you go forward. So what all the charts are telling us is this is what's likely to happen to go forward. There are some interesting things, and I'm sure I'll be around at the beginning of the year. There's, excuse me. There's a number of projects that I have in play that you folks are going to be part of. I am going to do a bit different content as we go forward, but this is really for the year end. And no, I'm not going back to every night videos. I wish, folks. Not a possibility right now, but this will be, but this whole long-term situation is really key. And it looks like it could drive this general trend, could end up easily being into May, June, and maybe beyond. We have an election year, and somebody pointed out, I think I once was saying that there's not been any recessions in an election year. That's not true, because Ronald Reagan I believe was during a recession. So there have been, but everything, if you look at what I've just told you, all of the metrics, I said there's no recession coming. If you recall, going back to last May, I told you that let's say in March, when we were supposedly where they were trying to build a banking crisis, which didn't work. It was a handful of banks that had problems, and the Fed came in, opened a discount window. That's what they're there for in those type of situations. And you could still own KRE. I'm not going to show you tonight, but you have the indicators. Put KRE up, put the Fibonacci tool on there so you can see Fibonacci targets, and you look at all the banks, the financials look really strong here, and it's kind of leading me into what I'm going to talk to you about here in a minute. But anyway, these longer term charts look pretty good. So let's go ahead, let's go to NASDAQ. All right, so same story. We're going to go top down, look at monthly, and then go weekly and daily. But you can see that the monthly is getting to a peak value, but this is a very robust trend that we're in. PPM1 is at 2.92. Those are insane numbers. It doesn't look vertical, but it is vertical. If I crunch it down, you start to see just how vertical this move off of last year's low really is. And remember, you were told that this was not possible, that the markets were going into recession. There was a banking crisis. All year long, you've been told that what happened couldn't happen. And so the point of all of this stuff that's going on is driven by, I told you I'm always data dependent. Well, my data is that database, and that's why we were talking about, when I went through a lot of detail tonight on there. So let's take a look, and let's go to the weekly. Still got a positive angle of attack. It's going to stay over 0.20 going all the way out into mid-January. There's always a possibility that we can test some of these moving averages, but on balance, these trends are positive, and there's nothing there that says we're going to just roll over out of nowhere and there's this big black swan event. That certainly could happen always. Those are the definition of a black swan is something you didn't expect to happen, right? That no one could predict it. So when we look at what's happening here at the PPMs, there does look like coming into maybe mid-January, we could start to see more of a consolidation, but we're just setting up the last couple of weeks of the year. We've got window dressing coming up. We've got all types of different elements here that are going to keep the market somewhat in a bullish stance from that standpoint, okay? So let's go ahead and just take a quick look at the daily. And this is where it gets interesting. We have some upward targets on the daily NASDAQ. And these numbers are all getting kind of crazy. 17, let me just bring it up here so we get the actual numbers. High target 17,789, 18,579, 19,068. So this, you can see the angle of attack here on the daily. And this, where my cursor is right now, you see the cross mark, that's Christmas there. So Santa is definitely coming to these markets for sure. And we should stay well above this, whatever the 10 period moving average should be your primary. Right now, that number is 16,033, 16,033. So this number will definitely be in play. And I've told you about these fib targets here. This is the fib targets up here where these green dots are above. And what these are, when you have PPMs accelerating like this, typically we could easily get to that minimum target of 17. And that's a huge number. All right, this is going to be the fun part here. All right, we're going to Russell, and this is going to tie together. I'm going to try to tie a section together here. Let me just do something here for a second. Yeah, I just want to come back on with you folks just for a minute and tell you what's going to happen here. I'm going to break down where I think there's going to be a rotation. I said something earlier that the rotation will occur only if this happens, meaning that we're going to see all-time new highs on the S&P and the NASDAQ, but we need to see the small caps rotate in. And I'm going to talk to you as we go from the Russell. The next phase we'll go to is actually going into the interest rates, and these two things are going to tie together. So this is the other narrative you've been told. I tell you folks all the time, you want to be good at the markets, just listen. Bloomberg is a bunch of clowns that are on there, especially all the so-called talking heads they have. All you have to do is listen to the guests they bring in and fade them. I mean, they're all as good as Cramer. Cramer just stands out above the bunch. But the bottom line is the narrative you've been told is that, you know, the Russell and I've been in this pattern too, and it seemed to be what was happening is that the higher rates were really going to affect the small caps. I've called them zombies, all of that. If the zombies wake up just a little bit, and I'm not talking about some massive bull market in small caps, okay? But what I am talking about is this rotation happening. All it takes is a little money to shift, and there's going to be some amazing rotation that happens. That rotation itself will fuel the market sentiment that will make it even more bullish. It's interesting that I'm just coming out of here raving bull tonight. So maybe that's a good sign that that'll be the top of the market, but I don't think so. There's too many factors set up. And as I always tell you, you got to watch for all of the different elements that are out there. You got to look. I'm looking at the database, reverse fundamentals. If the database is at 73% bullish on the intermediate and it's looking forward 100 days, what's going to drive that? And I'm going to break that down for you. What I believe is going to drive it is that we are going to see the back end of the curve come down fairly good. We've already seen it. There might be a little bounce here, but I'm going to set everything up here in this section. I'm going to go back to the charts in a minute, but I want to give you all of the backdrop so that you understand what we're looking at here is that the markets are going to make a shift. And if you're looking at all the indexes, even though I was just talking about NASDAQ going to 17.8, all these crazy numbers, if you're looking at things and you're an individual stock investor, ultimately, it just happens in a normal rotation. You're going to look for what is cheap. And if you can find what's cheap, where are you going to find that out? Probably not in the NASDAQ, maybe in the S&P in the back tier of the stocks, or you're going to find it in the Russell. So I would suggest those of you that are WaveTech users and you have our screens, I would look into that small cap, and I don't know, maybe there's such thing as a small cap value, but what I'm going to show you next here, I'm going to go to the Russell, look at some of these expectations, and then we're going to go to the interest rates. But I want you to have all of this understanding before I do this, so now I can just kind of flow through the analysis. But the bottom line is, if this shift occurs, which I believe it will, but that will fuel a whole lot of things. And one of the things, I've done a lot of Elliott Wave in my past, and WaveTech is actually a combination of moving averages, the PPMs, and understanding wave expectations, right? So the bottom line is, this is an R.N. Elliott quote, as he said, the hardest thing you're going to have to believe is what you see, what the charts are telling you. That's the hardest thing, and to buy in. Now, I've been fortunate enough, folks. I've been doing this for 40 years plus, and what happened during that time is building the database, building the models, doing this. I was talking to a friend of mine in London earlier today, and I was telling him this is decades of experience of watching the database. The very first iteration of the database was in 1998. Okay, so for the past 2.5 decades, this has been my normal routine, and I've seen all the ins and outs through all the dot-com bust and the GFC and 2018, and then followed by the pandemic. All of these things are the information that I share with you every night. So I want to set it up. If these are things that if you're going to see the markets really do some crazy stuff, you've got to bring in the small caps. Okay, let's go back to the Russell here. All right, so as we look at the Russell, look at this angle of attack that's building here. Now this is daily charts, and we're just going to, you can see for the most part, momentum is looking like it's going to stay intact as we come into year end. But let's get into some of the weekly numbers, and this is where it gets very interesting, in my opinion. And we've talked about this over the months, folks, a lot, as we've talked about this giant pattern that has been unfolding going all the way back into June of 22, and we just see this consolidation. Been 100 reasons why this index should have collapsed, but it didn't. We had the so-called, I'm doing air quotes, you can't see me, but the so-called collapse of the banks. You've got every amateur economic guy telling you there's a recession coming, the inverted yield curve, all this stuff. And as I've said many times, the inverted yield curve never mattered. And I've said that, I don't know, 100 times probably over the last year. What we are seeing, though, is it may get more inverted and it's going to be more bullish, okay? And I'll go through this detail in a minute, but look at these fib targets. Now, we're fairly close to fib target 1. Fib target 1 is 1932. All right, we are currently trading 1880, so we're about 50 handles off. But what I'm expecting to see here is that we could get into around 2050 as high as 2108. And that's still going to be within this range. Now we're going to go over to the monthly chart here, and I think this will make some sense as we come into some things here, is that the monthly chart is showing quite a bit of acceleration all the way into August of next year. There's still acceleration, and this upward angle of attack is unfolding here, and this is likely to keep the markets up in this range. And ultimately, if we can, I'm just getting some numbers for you here, but roughly just looking for a high, 2322 was the high, and we're at 1880. So this whole measure here, if we just look at the WTARs, or the auto regression on expectation for the future moving average, if I just put it on there, that tells us that the moving average is going to be at 2120. Most likely the markets will be some number above that, probably into this fib target range. All right. So let's go over and let's go to the interest rates now, and I'm going to tie why I think this is a possibility. So we'll cover the 10-year Treasury. I want you to look at the inverse of what the inverse is projecting. I've talked to you about this little triangle where you have an upward slope 40 followed by the downward slope 10. Well, it looks like that the treasuries are trying to roll over. There's some decent support, and I'm going to suggest to you that we're going to see at least a 3.75 10-year and the possibility of a 3.2. So 3.2% after printing basically 5. And so there are a lot of people telling you the same thing there. The folks that were buying the bonds last year and took a hit are now running a victory lap telling you that, hey, we told you the bonds were going to be a good investment. And what it looks like based on what we're seeing here is that we're probably going to come in to this range, and there's potential, depending on how long it takes for this to happen, there's a potential to see a sub 3% 10-year, which is crazy thought. But let's talk about what happens if that does happen. So I'm kind of in so I'm going to come back on screen again for you. I'm kind of in this, if I did them every night, I wouldn't be in this rant mode, but there's a lot of things going on here because this environment is contrary to just about everything that you'd want to believe is real right now, because you're being told, and I don't think I'm not big on conspiracy, even though Alex Jones is back on X. I'm not into that. But the bottom line is, what I'm trying to tell you is these things that are occurring in the markets, this is a big shift. And I'm going to tie back together, since we're talking about interest rates here, talk about the Fed again for just a minute, because I think the Fed is likely to maybe make a side comment about QT. And if they do that, that is going to trigger probably this rally. Overall, and I'm going to go back to the charts in a minute, what I see in the 10-year is some stability here around 4%, around that level. We could spike down to 3.7 or something, but it's going to come right back in again. So we're going to get some stability. And a lot of this, what I'm talking about, is a little later as we come into 2024 and coming into mid-year. So let's go back to the charts here. So you can see this is a monthly chart that I have up here. So we're looking at big trends. Where my cursor is right now is all the way out in December. So it's projecting that right now. I know these projections will change. Anybody that's used the auto regressions and the WTARs and all that, these will moderate somewhat. So I'm just going to target somewhere, like I said, 3.7, 3.5. And if I put my cursor right where all these lines are crossing, that's the 3.23 number. So let's back up. Let's go weekly. There's some Fibonacci targets. So I've talked to you so many times, folks. I appreciate everybody being part of this channel, and actually everybody's participated in our products and all that. It's just thank you so much. But the amazing thing is here we have some downward fib targets coming in right now, and those numbers are 4.15, and I believe we've just about reached that. We're a little short of that. 3.83 and 3.64. That's these fib targets here on a weekly chart. And you can see negative PPMs coming in. So let's go to daily. Now, this is where the bounce is being forecast. We're all the way. I remember, folks, just talking when I was doing the daily videos every day, coming in and telling you that there's projections on the Fibonacci that says we're going to come down towards the 200-day moving average. Well, here we are. That's 4.02. Let's see what the low has been 4.10. So it did hit that first number. What we're seeing here is a potential for a little bounce back into 420, 430, and then as we come into the beginning of the year, it looks like more downside on these intermediate charts. So just to tie all this together, all this together is, if this interest rate scenario I'm putting together for you right now, it comes to fruition, what's going to happen is that we're going to see a bid in the small caps. I'm going to take you away here for a second, and I'm still kind of combining the Russell, the interest rate, all this. I want to put this up, and this chart over here on the far side, I believe this is the weekly differential chart. This is the Russell versus the NASDAQ. I'm not talking about some big bull market. All I'm talking about is if we just recover this spread back into the level where my crosshairs is on the far upward right, if we just get there, this is what I'm talking about. It doesn't have to be some big bull market in this spread. All it needs to do is to come back. Now this, if I go over here and do daily, you'll see it's been bottoming here, but the weekly is the chart to look at. So keep a good close eye on the weekly pair from the standpoint of the long the Russell, short the NASDAQ would be the trade. All right, I think I finally got through that, folks. Let's move on and let's go to crude oil. We haven't done that one for a while. All right, so this is the daily crude. We've been under a fair amount of pressure. I actually saw an announcement that they are going to buy back some SPR. That's interesting. It looked like, I remember when we were just back here in September, everybody was screaming, we're going to, let me get to the weekly. We're going to, over here, we were going to go to 100. That was the dialogue. Once again, all you had to do was listen to what they were telling you and do the opposite, right? Everybody was screaming, crude oil is going to $100. Well, nope, we went to 70. So if you look at the trends that are out here, we are right at the 200 week moving average. I thought maybe we could get there. It didn't seem very, it seemed like somewhat of a far-fetched from the standpoint of it actually happening, but here we are, we've reached it. PPMs on the PPM2 is going to be under pressure. So what that tells us is we're going to get sandwiched between the 200 and the 21, which is going to give us a expected range. Usually I like to talk about what type of ranges are likely here. And we're looking at top end probably around 78 bucks. And we're looking at the bottom end around 70 here. We could print just a little bit more down. We'll go to the monthly very quickly. And so the monthly starts to paint just a slightly different picture where we're going to stabilize right in here around $65, $64 would be an extreme. It looks like the stabilization is likely over the next quarter or so. So that's about the best that you're going to get from the standpoint of crude. So I don't think there's a long-term decline down below in the 60 handle. Any 60s is going to be a buy point, and that will be, I think, where the market resides. All right, folks, we've got two more markets I'll cover. I'll come back on screen, and maybe we'll do a couple questions or something. We'll see how we end this thing. All right, so we're still on a monthly. There was a giant reversal last week. We printed all the way up. Let me get these numbers so we can get here. We printed up to 2152. 2010 was the low. We went out at 2021. Let's take a look at, you can see that the monthly looks like it, my analysis would be that we'll stabilize here around 1980. That spike up to this number was a lot bigger than I thought, but look at this. We had, I remember talking about the monthly that it seemed somewhat far-fetched that we would get up to the mid target here, but look at this, 2172 was that number. We got up to 2152. So we came fairly close to that mid Fibonacci. This is monthly. Now let's go down the scale. Looking at weekly, big reversal bar weekly. Algos are all suggesting that we're get some downward pressure, but once again, remember this number when we were down when we were way down into the lower 19 handle, 1960, 1980, these numbers are still in play. We're just likely just to go sideways in this range. And I'm going to put the floor around 1965 or so, just rounding numbers, and then expect, for the most part, to probably stay above the 10-week moving average right now, which is right at 2,000. So look at that number as a good, I think, backdrop. I won't go to the daily, really, but the weekly is showing that the short-term PPM1 is peaking out, but even if I look at the values here, we're still at a plus 0.4, and we see stabilization for all the way into year end. So just expect kind of bouncing around between 2150 and the 2050 and 22,000 as low, spikes down to 65 to 80 on the downside. All right, so final market, Bitcoin. What a crazy rally. Give me a thumbs up or a heart or something if you remember me talking about this vertical move and this angle of attack that was forming. If we went back not that many weeks ago, this was the algos called this thing perfect. What we're seeing now, though, is that we did get an RTX sell signal. We should get some consolidation, probably going sideways, but there's still an upward slope here. And this is the weekly chart we're looking at. You can see PPMs are trying to cross over, but even if I come way over here and I'm following this all the way into early January, we're still in the 1+ handle mode, which, if you recall, anything over 0.25 is bullish. And so that's going to stay intact for a while. And let's bring up something here. And here is the number. I think, who was it, just said something. Yeah, Brad just mentioned, this is the Fibonacci targets off the monthly: 55,879, 71,312, and then we've got, let me bring this last number up here, 80,064. So this is a retest of these levels, and I think there's a pretty good shot at this 56 plus number. It just, I'm not getting, with the monthly, I don't have enough data to get the algos to work. So this is monthly. So let's go back to weekly. Algos are suggesting momentum's peaking, but not turning negative. And it does suggest that maybe by March it will be negative, but that's not even in play. All of these algos are going to change as we get real data. They're going to moderate. Anybody that's watched the videos on using the 5-second chart on the ES, you can even put it on a 1-minute chart, whether it's crypto or whether it's any market you want that's fairly active, the E-minis. If you put it on a 1-minute chart, you'll see how the algos adjust as real values come in. And so that will happen. So some of this will moderate. If I blow this up on the weekly, just get this so you can see. This has been a vertical move. There's an argument, I was looking at this earlier, that this is wave 5 of this move, and we got, I haven't used my drawing pen tonight, so let's draw something in real quick here. And this will be, let me get rid of these arrows. So we'd be arguing 1, 2, this is wave 3, wave 4, wave 5, then we should get something, maybe it looks like this and maybe we set up a big wedge formation, and then off to the 55 number would be the expectations based on that monthly chart. And I did a post, those of you follow me on Twitter at Portfolio Expert, there's no E in expert, but those of you that follow me over there know when Jamie Dimon was out the other day talking about, he just hates Bitcoin because he can't make any money on it, although I believe Morgan has a pretty big trading room trading this stuff. But the bottom line is, this looks like this is the pattern we're going to do. Let's go to a daily. You'll see this. There's even a sub pattern here. There may be one more high in this pattern before we go lower. But look at the algos here. We're finally getting to the point where we look like we could roll down through the 10 period moving average. I'm gonna bring something up so you can see this. Okay, this is, those of you that have the indicators, watch this number. Whenever you see the fib, if you put the fib targets up here and the number extends, it's actually almost an error because it shouldn't. Once it's exceeded, it shouldn't be calculated. We've never, actually, I'm going to give you an inside secret. As one of the clients from long ago, and I know he used to watch the channel, maybe he'll know who he is, actually told me about this trade. When these things extend and they keep calculating, that we ended up calling them a pivot number. So this is your big giant support number, 41.2. And let me see if I can get an exact number on this thing. Bear with me. Yeah, 41.235 that's these green dots. And what these typically do is when we bolted above there and the PPMs were up like this was a signal for the further move up. We got 2 RTX cells, and I've told you this before. The RTX cells are not as good as the STX buys, but we did get 2 of them, and now we've been in a sideways mode here for multiple days. It looks like maybe we test this 10. We could see one more high in here. There's an argument for another high in this pattern before it completes, but even then there's some major support numbers. I'm just going to bring this back to tie it together. You can see I would look at these, not the PPMs, but the market grid numbers. We're looking at S1 42,920. We're trading 43. So I would call support between 42,920 and 41,900. So we'll just round off numbers, 42,900 to 41,900. That would put us in the S2 range. We probably see this market grid turn down and set up a sideways pattern that should trade us into this rising 10-week moving average. And that number, if we just, where it's being projected right now, if we come out to the 1st of January, we're looking at 40,340 would be that support level. Yeah, Chris Quire, I hope you listen, because I was one of those guys. Okay, folks, coming back up here. Thanks again. We've got a fair amount, a couple hundred people, so that's cool that everybody showed up. Thank you for showing up. And like I said, I'm not coming back daily. Not going to be around Wednesday to do anything with the Fed, but I do have some content planned. And one of the things that we're going to be diving into, everything I just told you, folks, you're going to want to manage portfolios and get away with just outright speculation. And I'm going to be doing a bunch of different market mastermind type things where we're going to do reviews of our product. We're going to interact with you folks. There's one coming up for those of you who came into the seminar. We're going to be announcing it sometime in the next week or so. It'll be early January. I'm trying to get some dates that I know I can commit to right now. And once that's done, we'll go from there. But let's see how far. Wow, I'm still in that same mode. I'm an hour in and I'm getting done. So that rhythm's still there. I appreciate it. Let's see if there. Yeah, that's funny. Somebody pounding 3,400. Good luck with that. Yeah, I appreciate it, Chris. Yeah, yeah. The Fed's listen. The Fed's. It's already clear that the Fed's going to hold. And just some final comments here. But that's not what matters. It doesn't matter if they hold. That doesn't matter. What matters is that QT stuff I've been telling you about. If they back off of the balance sheet, and I know hopefully I haven't seen him around, but Dr. Baker and it was more Baker than me, figured out roughly that the balance sheet on the Fed probably needs minimum 5.7 trillion, maybe 6 trillion. Everybody wants it to go back to how it was pre-2008. But if you look at the banking system, the economy, GDP growth, all of that in play, there's no way you can have a $900 billion balance sheet. You need, I think, around 3.7 to 4 trillion just to support the banking system. Remember, the Fed changed and the pandemic changed everything. All the metrics changed and how they work and what they were doing. Basically, they became the liquidity of the banking system. So money parked at the Fed, all of those things, we're looking at 4 trillion, and then you need some buffer for other things of that sort. And I'm anxious. I have a special video coming out to you, and I've been researching it for about a week. So it's going to be, I'm not sure when it's going to be released. It's somewhat not timeless, but it's not urgent to get it out at this moment. And I'm going to be working on some content. We're going to go back to the really high def camera and all that stuff, and it won't be a live stream. Anyway, folks, let's see, 219 of you. Appreciate it. Thanks for everything. We're coming up on Christmas and holiday season in general. And, I appreciate everybody as always. And like I said, this may be the final live. This will probably be the final live broadcast of the year. Although I get messages on Twitter and on YouTube everywhere that you folks miss me. I miss doing these. It's part of my daily routine. It's felt very odd many days being in my office and not going live. And so, but it's a necessary thing to switch. And I think ultimately, when you see what we're working on to bring to you, is somebody made a comment, I think it was on DM on Twitter or something, or somebody I followed is like, Bob, teach us how to fish. That's what I'm going to. I'm going more educational, more about how to fish. And I'm tired of fishing for you. I did a lot of fishing for you tonight, but I think I'll still do probably occasional live stream or something to bring in perspective and things like what we did tonight. So anyway, folks, based on what we got here right now, as far as this is kind of a typical stream. So hopefully we get a lot of views. Just remember, don't forget, if you haven't got the indicators, get them. But there is a special coming out by the end of the week. I'll be announcing that. So hopefully you sign up for emails, and there should be, I know we've got a pretty large email list, and we'll put some things out on Twitter. And I'm at Portfolio Expert, no E in the expert. So anyway, folks, thanks again. I keep calling it Twitter, X. It's hard to call it X. But follow me on X, and I'll try to keep information flowing there. There's not going to be a lot of interaction, but I do have plans for more content. I'm also working on getting the Substack account going again as well. I was active early in the year. I've got some content there, that there's a video and some content that I'm putting together, and we're going to start getting that going too. So just watch Twitter. I'll put it out there, and I'll let you know via emails and other things. We try to be pretty good about spamming or constantly trying to sell you guys products. I think the products will help you a lot. I know a lot of you folks already have them, so and great feedback and all that. So anyway, you can go to kendallreport.com/indicators, and if you send us an email, we'll put a special code together and we'll announce some kind of code. Thanks for watching again. We'll talk to you next time we talk to you. Take care, everyone. I miss this music. Merry Christmas, everyone. That is appropriate. Happy holidays.